Welcome back, ladies and gentlemen. After a crucial earnings season with some of the top-tiered tech companies, it is not enough to rebound the S&P 500 back to some of those highs that we recently saw. And considering the last stream we did after Microsoft posted crushing earnings, the stock tanked 6-7% in after hours to only rebound and go up like 4 or 5% the next day. We saw Tesla come out with great earnings. They missed on some of the margins. The stock started rallying and then fell off to new lows that we're seeing today. On top of that, I was just listening to the Apple earnings here, folks, and Apple is literally the tippity top of the tower with the S&P 500 largest weighted company, and the earnings absolutely crushed it. I literally just closed the earnings call because they're in the Q&A period, and I feel like I got most of the stuff that mattered. And as expected, guys, M1 chips crushed 25% growth out of Macs. iPhone sales crushed, even though there's been a lot of debate around the Google Trends with people searching up iPhones. And on top of that, guys, they didn't want to screw themselves. And I thought it was hilarious that they refused to offer guidance in 2022. The companies that really quickly picked up on offering guidance is the worst thing you can possibly do in this market. And just taking a look right now, let's just see how Apple is doing in after hours, because every time I looked at it, it was petering to the upside, but you cannot trust any of this because every rally has been bitten off by sells. And look at that. I mean, Apple rallied extensively and now it's back down, only up 2.6%. I think after being up 4% in after hours, the volatility of this market just does not sustain here, folks. Well, it does sustain. It never seems to slow down or moderates. But what we're going to be discussing in this video is kind of just expectations, kind of how I feel about the market moving forward. We still got Google, we still got Facebook coming up in the next week. Those are going to be very critical considering we're all YouTubers here. A lot of us know that the ad rates have fallen off to unusual lows. Facebook can be really intriguing considering the Oculus was more popular than the PlayStation was by Google search traffic going into Christmas. So it's going to be neat to see how all of this bakes in. But hey, at least we know one thing for sure, and that is that big tech is not slowed down. We're still at these incredible, huge growth rates. And it's just nice to see how these large caps are integrating together. I mean, Apple just said that Shopify is utilizing their MacBooks for their entire suite of business, which is pretty incredible to hear. So there's a lot to look forward to, but what we can't look forward to right now is the stock prices. But why is this a beautiful thing here, folks? Because if you're like me, you're trying to accumulate shares, and considering share accumulation seems to get easier when valuations start making sense. This is where I'm getting really intrigued, and I've already started to pick up some stocks, and I'm just finishing up tax season right now, so I am going to have a little bit more liquidity. I'm trying to think about how I can play both ends of this market, because typically at the bottom core of my life here, outside of the corporation, I am always a dividend kind of first investor. I really don't like buying companies that don't pay dividends, because when we head into these volatile moments within the market where we might not get rallies out of stocks for potentially 6, 12 to 18 months potentially, it's kind of annoying not to be having cash flow to offer some more liquidity into cash flowing back into the investments, right? So I'm keeping an eyeball on so many sectors of the market right now. I mean, I'm glad that I doubled down on banks, because that's what's been really offering me stability throughout this kind of market volatility. But at the same time, guys, you're looking at things like Pfizer, Moderna. I mean, Pfizer's revenue growth quarter over quarter has just become astronomical, yet the stock is just trading down massively with a starting yield right now of something like 3%, which I think is incredible for those long-term, aristocrat kind of investors. McDonald's, man, like Starbucks. Like, I'm always kind of reiterating back to these older stocks that I've always been intrigued by, but I never bought because I either missed the bottoms, allocated capital elsewhere, or just got tired of them rallying so much. So I'm constantly looking at my portfolio, because in the next 6 to 12 months, my life is primarily going to be changing as I kind of move into different living circumstances. And when I do so, I think I'm going to be looking for more stability in cash flow. And I might look at rebalancing part of the portfolio. If I was smart, I would have rebalanced toward the end of last year, maybe took a little bit off the tech top. So when they kind of dropped here, I could have went back into them, but I don't play the short game. I don't know what stocks are going to do today, tomorrow, a week from now. I just try and predict on what I think is going to be the best balance sheet companies. And right now, guys, to be honest, I am avoiding the small cap sector like a plague right now. I have a really good time looking at some of the more volatile companies like Shopify, like Block, like PayPal. Like a lot of those companies are coming into actual value territory for the growth that they offer. And I want to ask you, are you guys picking up those kind of growth small caps? I know people in our chat groups have been cost averaging into some of those more speculative plays to varying degrees just because the deals just seem too good. And to be honest, I'm curious if we're finally hitting bottoms within this market because we're seeing the S&P start to level off. Earnings weren't able to rebound much, but the earnings were just leading to more volatility and not much more downside yet. I mean, we could still go further down. I noticed a lot of the small caps were retesting lows right now, but they don't look like they're breaking through to new lows. So that's also a good sign, but none of this is really going to encapsulate much until we get a good solid month of stability. And a lot of this is going to lead into the next Federal Reserve meeting. I've been looking at a lot of commodities again, because when you look at gold markets and stuff like that, guys, I found it really intriguing that gold purely trades off the interest rate market right now. So the Fed didn't do any surprise interest rate hikes. So gold actually plummeted right after that Fed meeting. But historically, guys, literally for the last 5 rate hikes over the last decades, every single time, 100% of the time, gold has gone up pretty substantially. Whereas most of the gold commodity stocks, it doesn't matter what it is, are trading way below their values, considering all commodities are still skyrocketing, right? Earnings seem decent, but guidance seems vague, more FUD. Yeah, I honestly think the guidance is going to be fine for a lot of these companies in the large cap sector. I just think they don't want to offer it because they know that it doesn't matter what. I don't think it really matters. You lower guidance slightly at all against analyst expectations, and the entire stock is just going to plummet. We learned why that was a completely terrible idea here, right? But I honestly think in the next 3 to 6 months, as Meet Kevin's broadly discussed too, that's when I think we're going to get more stability because we'll start getting the idea of what the Fed's going to do, how aggressive they're going to be about hyperinflation. And I'm just kind of reiterating that this is probably going to be the best time to be buying stocks. I'm going to make a prediction that by the end of this year, as they kind of mentioned in the Apple earnings, and I wish they discussed more about it, because I think the last quarter earnings, they really touched on how much money they were losing to supply constraints. And I think that's the next big bull market we're going to head into. I think once we stabilize this year and we start getting to the end of these headwinds, that's when you're going to start seeing companies like Tesla, companies like Apple, Microsoft, these companies that are highly proponent to chips. I mean, even Starlink still hasn't shipped to my house yet. I ordered that so long ago. That was supposed to come last fall. So you really see the next explosion coming when these companies can start reaching full steam again and start delivering on the demand that exists in the market. But for the time being, it's a complete and utter shit show all around. Hello from Ireland. Oh my God, we got dude all the way out from Ireland here. How's the European markets doing, man? Are you buying into some of these US markets right now? It's been a volatile ride. I'm just slowly averaging weekly into my boring dividend stock. See, it's not boring. That's why it's exciting, man. There's a guy in our chat group, started last year pivoting only into dividend stocks. He's been very prudent and cautious about how he's doing this over time rather than lump sum investing. And now he's getting like $1,500 a month almost in cash flow with a goal to get to $3,000 a month. And this is when dividend investors shine, man. I mean, you're looking at things like Unilever trading down pretty heavily. Thoughts on Tesla earnings? They missed on margins, which I think is what shocked most people. But honestly, they're crushing it, man. It's so funny because anytime Elon gets on a conference call, there's always like one sentiment across like the crazy YouTube Tesla bulls, and that is, this is the greatest earnings ever. I mean, Elon offers so much insight into shit that doesn't exist yet, and that's usually where the criticism comes from, right? Like Elon was really reiterating that like we don't care about the $25,000 car right now because we have so much demand, and where margin's going to like crush the auto industry is if we can solve the problem that is self-driving. The thing that I like most about Tesla right now is I think they can actually fair value their market cap just off auto sales. And I know people are, oh, that's crazy, man. They're like the 10 largest auto companies combined, but I think people really are misappropriating if they don't look at the volume and traction that I personally think, if you just run the math and you look at the scale of the volume they're doing with the production they have off the current factories, and then you're going to have Austin come online, you're going to have the European factory come online, and considering that I always kind of go back to Norway right now, because Norway is like the prime example of what the EV market I think is going to look like globally, because I think right now over 50% of new vehicles sold are all electric, and Tesla's dominating, considering they don't even make Teslas right now in Norway or Europe. So when you look at like the US and how much market share the largest companies lost, like GM, which we were talking about in our chat group over the last 10 years, the fact that these Chinese automakers are now just dominating most of the global ICE vehicles, the internal combustion engines. So I kind of just keep formulating in my head that I'm not going to be surprised by 2030 if Tesla starts owning somewhere between 30 to 50% of the total EV markets in the US. Global market share is going to be dependent on how much these other EV makers start capping in some interest. Because again, this is the first time ever where the legacy autos are competing with a new run up of companies. I mean, we're still talking about things like Lucid, Rivian, Neo. So I think it's going to be a fair competition, primarily between Tesla and China. I think Ford could bear well through a lot of this, but it's hard not to be bullish on Tesla, the business. It's easy to be bearish on Tesla, the stock price. So I always kind of reiterate that if you're looking for growth companies, the question you have to ask is, what list of companies do I want, and at what price am I going to be getting into them at? Because I feel like people want to debate value and they completely disregard the underlying business a lot. And I see this a lot with companies like Nvidia. And I really like channels like Everything Money because they're very prudent and pragmatic about the valuations they pay, and they constantly analyze what I think are the best company balance sheets that exist in the market. So when you're looking out there, guys, it's not a matter of do I hate or like Tesla. At this point, it's a matter of at what price am I willing to buy into it. If you're looking for some of the greatest companies on the planet, balance sheet wise, I mean, you're basically going to be buying, if all the auto stuff works out to the higher degree. I mean, you're basically paying that in the market cap now, probably looking about 7 to 10 years out. And then if they do what Elon thinks they're going to do, which he said many of times in the past, is that they're going to solve self-driving this year. It's very likely. Not that that bakes into any margins this year, because there's still a lot of regulatory stuff that has to come into play. But if they actually solve this, see, this is the thing that's brilliant about Tesla. It's like you get this proven business model that's scaling right now, and then you're getting this ETF of everything from batteries to energy to robotics, which he talked a lot about. He thinks the robotics part of their business is going to be bigger than even the auto parts of the business, because the end all be all product to humanity is solving mundane work, whether you're sitting at a factory at Amazon or trying to clean a house or flip a burger at McDonald's, right? Like robotics can solve a lot of that. And it's funny too, because when you talk about this future forward looking stuff, and my parents especially, like I have this discussion with them a lot, because my parents are kind of old school. My dad's always like, oh, do you think the market can change that fast? And I'm like, you have to remember, the iPhone only came out in like what, 2007, 2008. Look at where that company's at today because of that product launch. I mean, we're barely like, 15 years deep into that product now, and it's just completely destroyed the entire sector of phones and how we utilize our day-to-day lives. So I think people need to it's kind of weird because you're kind of over anticipating, but you don't want to under anticipate either. Because if Tesla just solves one of these grand problems in society, I mean, that's kind of the bet, right? Underlying business, same thing with Facebook. You're getting this really robust underlying business. And if they can solve just one of these problems in these multi-trillion-dollar sectors, guys, I mean, this is the problem, right? Is waiting, because it's fun to talk about this now, but the thing is most people aren't going to have the patience to sit here and ride through this volatility for the next 5 or 10 years. So the way I've kind of structured my portfolios personally is I'm trying to navigate all of my growth into my corporation, because that's where I'm going to pay the least amount of income tax. That's where I can defer taxes and control how I pay myself. And that's where I want to continue to get growth within my business and the capital that my business operates with. I just want it to be strictly growth related. Whereas from the personal side of my life and my personal income, I'm getting this nice stable job income now, which I really appreciate. But I really want to make sure that my TFSA, my RRSP, my general brokerage account are really cash flowing heavily, because that's what I'm going to be relying on when these markets kind of flip to the other direction, right? So that's kind of how I personally set up my life here. So that way I have a little bit more control over the growth side of it, because with my business, I'm all about growth. And I think that's the most prevalent, considering I'm trying to grow a business. Whereas personally, I think it's more prudent to be a long-term investor, right? Because we were just joking about this with the Doge millionaire, right? Like if that guy even sold off half his portfolio and invested it in long-term, foundational stocks, and there's tons, McDonald's, Procter and Gamble, Home Depot, Colgate, like I can list those kind of companies that everyone should own if you're starting to scale large amounts of capital, especially if you're young, because that's going to project out. Yeah, your returns aren't going to be insane, but give it 10, 20 years, compounded dividend growth, you're going to end up in a fabulous safe position and in a good retirement. Whereas if you're speculating on things like Tesla, like at any point in time, I mean, it doesn't take a lot for Elon to say one wrong thing. It doesn't take, one wrong quarter for Facebook to drop and take several months, 2 years, 3 years to recover. Like, I'm always prepared for growth to stagnate for 2 to 3 years. I mean, that's what I kept saying. If you guys are buying the tops of the market, it's what I kept saying about the ARK ETF, a lot of the ARK holdings, Teladoc, all that stuff. I love those companies, but you have to recognize the value fundamentals. And the fact is, if you're going to overpay today, you have to be prepared to wait for valuations to come into play for the next 3 to 5 years. Same thing with large caps. Finally, the large caps are becoming more fair valued. This is like the best time for newer investors to start cost averaging into large caps, in my opinion. Yeah, the yields aren't great, but the stocks have sold off, not to levels that I would want them to sell off to. But the fact of the matter is you're always going to pay a premium for solid companies. And the fact of the matter is, guys, at the end of the day, there just isn't that many companies like Apple, like Microsoft, like Tesla or Google. There's just not. It doesn't matter how much you can dig through small caps. There's no balance sheets like those companies on the planet. So guess what? When the market rebounds, guess where most of that money is going to come back to? The best balance sheet companies on the planet. This is why I try and primarily play around in the S&P top 20 to 50 companies, because all these companies that I'm mentioning, guys, if you just look up the S&P 500 and go through the top 50 companies, you'll find your best dividend stocks, you'll find your best growth stocks, and you do not have to look much farther unless you're looking to speculate and gamble, which again, I think is very important for newer investors. And I think looking at small caps right now could bode the best returns sometime in the near term, but it's understanding that risk tolerance and not just, saying because they dropped more, I should cost average in. I mean, look at the people that were cost averaging in on Lemonade, SoFi, Palantir, Wish, Hyliion, Nikola. Like, if you got caught in that cost average cycle on speculative investments, you're not sitting pretty today and you're not sure if you should continue to, right? We got about 15 to 18 days for a major drop. What makes you say that? I would be kind of surprised at how much we drop from here, because the problem of the problem is, again, these companies are too good. They are far too good right now for them to just tank 20 or 30% unless there's some other black swan event, right? That's why, like, when you see these 10% drops in the S&P 500, it's more prudent to start cost averaging in, maybe a little more aggressively than usual, but you need to take advantage of the opportunities when they exist. And now they're starting to exist. So, like, I bought Tesla at 917. Wish I caught it in the 800s, but you take what you can get while you got the capital to make it work, because you don't know what tomorrow brings. I mean, Tesla could drop to 5 or 400. I wouldn't be surprised, but I just have a hard time when you look at the amount of excitement around Elon Musk, if that's still a full likelihood. But who knows? Nobody knows, right? I mean, Apple, we'll see what tomorrow brings for Apple. Where are we sitting in after hours now? Because, like, I mean, Microsoft was the most mind-blowing crack addict trading I've ever seen in a large cap in a very long time. I mean, to watch Microsoft drop 7% in after hours to fully rebound and be up 5% the next day, we are talking about hundreds of billions of dollars of hedge funds shitting their pants and some idiots feeling like they sold the bottoms. I mean, some idiot has to sell you these prices down here, right? And I can't imagine those people feel too good about themselves when they see those massive spike ups right after they sold the lows. Why you do not want to be a crackhead in this market. You need to have a strategy. Always need to have a strategy. So Apple's stabilizing up about 2.74%. Tesla to 300 lol. Hey man, it could happen. Like I said, I don't speculate on what the price is going to do. I just speculate on the businesses, and it's bode very well for me in the past, right? It's just finding best businesses possible. And then worrying about the stock price secondary. Well, you should, I mean, always worry about stock price to some degree in the values, but business model always comes first. PE ratios are high compared to the historic averages, but do you think that's because investing is more easily accessible due to the internet, that PE ratios should be higher than historical averages? Yeah, see, that's an interesting debate, actually. I kind of flip-flop in my head about that idea all the time. So look, we're in a crazy growth market right now. These higher PEs, I think, are just to varying degrees, just because if you went back when Apple was trading at a what was like the PEs were sitting between like the 10s and 15s. I mean, back then those things were looked at more of like, regular kind of growth companies, because, they were still trying to bake in the future value. Do you remember every year, and still now, every single year for as long as I've held Apple, everyone's like, hey guys, iPhones are done. They've hit max market saturation. They've been saying that for several years now. And I think because we're pulling up, I mean, look at their friggin' gross margins, for Christ's sakes, like 46% on a company that's making that kind of money. Like, in this supply constraint problems, like holy crap, guys. So I mean, it's not unjustifiable. It's crazy valued because again, we're pricing in like 3 years of this growth. But so, like I said, you're going to be paying a multiple in this market. There is no way we go through a full price correction. A lot of people are calling for a PE correction in the market where we see everything cyclically pull back, maybe bringing PEs into fairer valuations. But that doesn't make a whole lot of sense when these companies are still growing at 20 to 30% rates. I mean, you look at Tesla's growing revenue like what 50% rates, and you look at the PE that has, and you look at small caps that are growing revenues at 50% rates, and we're putting PEs on those in the 500s to the thousands for Christ's sakes. They don't even have PEs. Yet, when Facebook's trading at a PE of 20, oh my God, it's overvalued when they're literally growing gross margins and revenues and EPS numbers like they're small cap companies still. So, I mean, until that changes and we start seeing like basically most of the large cap companies start trading up like revenues, maybe 10, 15% growth rates, which is highly conservative in this current market, that's when you'll start seeing a PE value correction. But again, guys, you're talking about a market here where these companies, I mean, Apple's like what, 100 billion, I think they posted in cash after tax, I think it's 80 or something billion dollars. Like, I mean, you're talking about share buybacks. Share buybacks are always going to boost EPS numbers. They're not stopping that. That's going to change the valuations on the market. I mean, you're talking about them investing capital like Facebook is. If they get a return on that capital, say Facebook does with Oculus, that bodes well more to the growth side of it. Same thing that Apple's seeing with their service industry, like massive growth. I mean, all of that continues to bake into growth. So it's hard to value it at a PE ratio until you start getting into the 30s, 40s, 50s. I mean, Microsoft got real high there and it was kind of getting out of bounds. I mean, a lot of people were feeling that it was just getting too astronomically high because, again, you're going to have to sit there for 3 years for it to start making sense. But now, especially after these earnings, guys, 2022 is going to be volatile. Pick up the dips. Just take the dips when you can and just keep taking paychecks and keep cost averaging. Tesla to 300 is entirely possible. I 100% agree. I think Tesla, Elon could say one wrong thing, but for as long as we keep getting these 50% quarter over quarter growth numbers or these just annual insane revenue numbers, there's just no way. Like, Tesla can only drop so much. Microsoft can only drop so much before someone says, hey, this is a deal. And that's what you're competing with. And as long as hedge funds, and I've watched a lot of hedge funds lately talk about Tesla, and they are buying these dips. And we see the dips get bought, right? So the question is how low can we let it go before we start meeting these bottoms? And again, there's always black swan events with every company. It takes one bad news article for any company to take a shit kicking. The only way these companies show value is buybacks. And when interest rates rise, it won't be effective for these companies to take loans. Yeah, but does it matter? Does it matter? Facebook can pay off all their debt. Apple can pay off all their debt. These large caps sell off cyclically in an interest raising environment as growth companies, but why? They don't need to borrow money. It doesn't make any sense. That's why the whole interest rate environment shit, it's so illogical in the current market cycle that it's just based off like historical facts and hedgies out there deciding to move the markets, probably based off cyclical fear to try and buy into the dip. I mean, there's no justification, no idiot that sits here is logically going to try and explain to you what these market cycles are based off of because of what the Fed's doing. It doesn't make sense at all. Now, from a macro cap, like if you tell me like a company like a utility, a real estate investment trust, a small cap company that has no earnings that's relying on debt and raising capital in the public markets, yes, interest raising environments are not going to bode well for them. But that doesn't make any sense for any of these large caps. There's no reason for it. And like I said, we're going to get to the other side of this pandemic, and it won't matter that interest rates are rising because we're going to get through the supply and logistics nightmare. And then all of a sudden, these companies are going to be posting even better numbers. And it's just like, boom, we're back into a bull cycle all over again. Again, this is all speculative. This is just how I've kind of seen the market or how I see it, but I could be completely wrong. Keep that in mind. This is all speculative by nature, all of it. I'd be curious to see how PE ratios are affected by the percentage of population that has invested in the market. So that was a good point too, that there's a lot more newer people getting in the market, which also drives valuation to better companies. But at the same time, look at what happened to Robinhood. I mean, most of the newer investors, the retail market guys, they were driving into the GMEs of the world, as far as I could tell. They were taking on like Reddit, Wall Street styled bets. They were listening to people like Meet Kevin. They were highly risky invested, and now they're pulling out of the market in droves. I mean, go on Google Trends and look up Robinhood. Go look up stocks. Like, I think that's mostly retail market. It's definitely terrible because I feel like there's a lot of guys out there that might never come back to the market because of the money they just lost. Like I said, you don't hear those stories often enough. And I wish more people would come out and we could actually see who's selling these bottoms, because only a moron is selling out at these prices, especially if they bought the highs and waited till now. And somebody had to. Somebody's selling the bottoms here, guys, in these small caps. So I can only presume it's the retail investor, because nobody with 2 cents in their head is going to be like, "Oh, I'm gonna take this deal." Thank you, passive income investor, putting great content out. Much needed Canadian perspective. I definitely appreciate the dono there, brother. But like I said, I just do this for fun. So long as you guys don't beat me up too much for my sponsored videos, because that's how I'm funding this channel and kind of making it to keep doing these videos for free, because I don't make any money off the videos I post, folks. I get a lot of heat for these sponsored videos, but I got to do them, man. I got to make money. I'm not Meet Kevin. I'm not posting a million views every other day here, bro. So I'll try and stabilize out my sponsor videos to not be too annoying, because I think I picked some pretty good ones, and I do like a lot of the companies I work with. But I do appreciate the donation. Thank you. I wish I could give you something back. If you want, maybe I could send you a free chart from the chart master or something. I really don't want your money. I just like talking, and I'm glad that there's an audience here that has an open conversation with me. I'm a newbie investor, a little under 2 years in the market. About 80% of my portfolio is CHD. Love those stable cash flow companies. 80% of my portfolio is CHD. What is CHD? CHD. I will just do a few comments here, guys, and then I'm going to get out of here, because CHD, Church and Dwight. 1% yield. It's not trading down too much, about 5% in the last 6 months. Looks like a very stable company. It's been doing very well over the last 6 months against the market. I'm going to actually leave this open because they've done well with earnings as well. So maybe I'll take a look at this one. If you know you're doing, if you know what you're doing, you buy low and then sell high. Yeah, that's the hard part, because sometimes waiting for those highs to return is patience. That's the true test of patience, especially the true test of if you made the right investment decision. If you start paper handing this market, it just proves that you didn't do the amount of due diligence that you thought you did. Because I'm not in any way excited to sell any of my companies in this market. I'm excited to buy them. CSCHD makes yeah, okay, so that's probably what we're talking about. CSG is a pillar of my stability. Yeah, I mean, I'm really looking at some of those more stable companies, man. Like I said, I'm really concentrated in a few companies in my personal accounts, and I feel like I should be higher concentrated in the growth companies I believe in, and more diversified in my TFSA, my RRSP, because I'm really concentrated. And when I look at it, I kind of don't feel like comfortable about being so heavy weighted in banks and some of those other companies. But I'm debating on, like, if I'm going to cost average myself into some more cash flow companies, what would I want to buy and how do I want to go about leveraging them down? Because when I look at the Canadian markets, I'm looking at things like the telecoms, TELUS, Bell Communications. I'm looking at some of the larger cap companies. Even though I might not be the biggest fan of them, it doesn't mean that they're not good companies. And sometimes just because you're a fan of a company or you think you've done all the research on the planet, sometimes just throwing a dart at a board with good dividend companies like your Home Depots, your McDonald's, your Procters and Gambles, like not worrying about the valuation metrics as much and just cost averaging into them usually doesn't do you too wrong. Do you think Apple can take on other fintech companies like PayPal and Square? I don't know why they haven't. I know they got the Apple Wallet, but I don't use it. I know some people do a lot. I haven't got into the Apple Pay stuff just yet. To be honest, I'm more intrigued to see how PayPal bodes. It's at a great valuation. I have such a hard time with PayPal because I fucking hate their business so much because they just rip me off. You can tell over time that PayPal continues to irk me in a lot of ways, but right at this current valuation, you can't help but seeing them as a crazy buying opportunity. I'm just curious to see, because now you have a lot more than PayPal, right? Which my girlfriend made a good point today, that she doesn't like PayPal because she can't buy things at Best Buy. You can't buy things at retail stores with PayPal, which is somewhat frustrating. Whereas, like, even with Shakepay and some of these cryptocurrency, actually, does PayPal offer a Visa card at all, a debit Visa? Because, like, even these cryptocurrency exchanges, they give you these Visa debit cards where you can actually purchase shit in stores, which I think is a huge proponent to some of the problems with PayPal. But I don't know who dominates the space, man, because I mean, you're looking at I'm the fintech space is confusing just because of blockchain technology and just efficiencies and not having to pay such high fees. And I'm not sure who's going to win that game, because there's going to be a few large winners, and PayPal is trying to pivot that way. A lot of companies are Square, so it'll be neat to see. But yeah, you pick your few fintech. I mean, I mainly buy banks for fintech because I honestly think banks, the thing that they have over, say, a lot of the, because banks work with Visa, banks work with all the credit card companies, but what banks have that crypto will never have, that people just seem to think that they're dinosaur companies that are extinct, is leveraging. You're not going to be leveraging crypto into a real estate asset because you need somebody to secure the liability. And there's only two ways to secure liability. That's with assets backing it, or that's specifically with cash flow and income. And most people buy assets based off security of income, right? So if you're buying a mortgage, let's say, the bank is going to judge the security of your income and your job, and they're going to loan you a percentage of capital based on that. That doesn't happen in the crypto space. You want to see a company, you want to see crypto go to zero real fast. Let's start leveraging people it. But that's, luckily the crypto market doesn't allow that. So I mean, I could see smart contracts and things of that nature boating into the real estate market, but I just don't see how you disrupt banks, because people want security, man. You get security in banks, you get leverage from banks. So that, yeah, SoFi to $50 within 3 years. Is SoFi, man, it's crazy. I'm seeing SoFi commercials in Canada now. I honestly think SoFi is probably one of the better small caps in the fintech space because they're just so good with marketing. They have such good plans with consolidations of debt. They're just doing so much, and they're really like global expansive looking. So I mean, in the price you're paying for it today, I mean, it's great. It's great. But yeah, I play around with big banks over some of the fintech plays like Visa and the pure plays into credit transactions, because you get exposure to Visa through the banks anyways, and MasterCard. Everybody having fun packing up the truck. Meanwhile, I'm just putting the same amount in every week for the same boring dividend ETF. But that's not boring, man. That's not boring to me. I know we're sitting here and it's fun to talk about these other things, but I'm all about cost. I bought more S&P 500 index. I want to honestly make index funds somewhere between 20 to 30% of my portfolio at some time in the next couple years. I don't think there's anything wrong with index funds, bro. I think it's the easiest way to get rich. I think you could easily look at dividend, the Vanguard high dividend yielding ETFs for cash flow, and not have to worry about a single company in there. Because a lot of people look at that and they're like, oh well, Exxon Mobil's in there. A lot of these oil stocks and companies that I don't particularly like, but that's the best thing. You don't have to care about it because right now that those companies own. So I've said this before, but I think people don't understand why Apple is such a large weighting in the S&P. Because when you look at Vanguard and the structure of those ETFs, they're based off market cap scaling size. So if a company has a bigger market cap, it becomes a bigger weighting within the overall portfolio. If it has a smaller cap, it holds a smaller weighting in the overall portfolio. What has that done for Vanguard? Well, it basically gives you the best possible companies at the best scale possible. The bigger the company gets, typically means it's doing a very good job with growth, which therefore you're going to own a bigger percentage of it, right? It's actually a genius system and it's all completely mathematically operated. It's not done through emotion at all. So you don't have to care about what's good and what's bad in the ETF. If it ever goes out of favor, hey, it's going to get lower weighted and something's going to take over that position. So it's like you're always cost averaging into the best possible companies that exist in the planet based off market cap. And that has made Vanguard literally the only ETF on the planet to make more people rich in America than basically any other. I mean, Jack Bogle, rest your soul in peace. I mean, the system that guy set up has literally boated to the best returns and the quickest and easiest path to wealth in America for the average person. Because the average person can't do real estate, the average person can do stocks, and they don't even have to do that thanks to the invention of the ETF. That ETF specifically, I mean, they were the ones that launched the idea of it, right? So, what do you think about making 50% of my portfolio TQQ? If you're young, you're into the risk. I mean, by all means, go for it, man. It's just it's its own thing, man. It's its own thing. If you want to take that on that kind of growth, it's just the hard thing, right? That I have with TQQQ. The reason that I don't buy it is I'd rather own the QQQ ETF, but I'm not as risk adverse as you might be, because when you look at those weightings, they're very overvalued. And like I said, if I know that I'm going to be sitting here for 3 years for the valuations to catch up to the earnings, it's really scary holding a volatile asset like TQQQ because you're going to be looking at these 30 to 50% mood swings regularly. Again, if you can hold on to it for 5 or 10 years and you're very bullish on those stocks as I am, you could make a very good return. It's just a matter of I don't have the risk tolerance to make it that large of a position personally. He just learned the word bode, the bode well. Yeah, I say a lot of weird words sometimes. Try and sound smart, you know. I don't know. I'm just talking out my ass, right? I really want to build a position in SoFi. Yeah, Ryan, are you buying a house? You talking to Ryan in here? 50% cheaper, exactly. Blah 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 blah. Anyways, folks, this has just been a quick 30-minute discussion. I appreciate you all coming out, just talking about the earnings cycle, predictions for the next 6 to 12 months. It's going to be a volatile ride. These dividend stocks, lots to look forward to here. I'm going to keep pumping out content on the regular, doing my best for you guys. Really loving these markets, man. It's just like you get so bored with video games. There's a lot of shit in my life that just becomes boring over time, but the markets, baby, they never become boring. There's always something going on. So stay cool, stay awesome, folks, and I'll catch you in the next one. Peace.